Bob Johnson, why should I ignore what my financial advisor says and simply invest with the Fed?
Well, first of all, I hope that people aren't ignoring what their financial advisor says, because I hope they are getting good financial advice from qualified financial advisors. But we have found that there are strong monetary policy-related return patterns in the stock and bond markets. And that is long-term, when the Fed is expansive, stocks do well. When the Fed is restrictive, stocks do poorly.
But the Fed is hard to figure out. Most recently, Janet Yellen took out the word patient, but she still remained dovish, and the stock market took it that way. So can you help me parse that language? How do you reconcile it?
What we do in the book is we don't look at what the Fed says, we look at what the Fed does. And we look primarily at two interest rates, the Federal Reserve discount rate and the Fed funds rate. And when both of those are trending downward, we say it's an expansive monetary environment. When both are trending upward, it's a restrictive monetary environment. So again, it's more what is the Fed doing and not what they are saying.
All right, so how do you invest with that in mind right now?
Right now, I would be very cautious because I think we are anticipating that they're going to hike interest rates at some point. Again, rates are historically low, and the next move obviously is going to be in the upward direction. Having said that, what our research shows is it's not the level of rates that's important, but the direction of the movement of rates.
And the Fed clearly has an impact on the ECB and the Bank of Japan. So talk about how those three play together. If I'm investing with the Fed, am I investing against the ECB? Am I investing against the Bank of Japan? Tell me, put that triumvirate together.
What we have found, and again, we're looking at what has happened in the past, what we have found is that developed markets generally move together. That is, the Fed has a big impact on developed markets, and developed markets' returns tend to be synchronous. What we have found also, though, is that developing markets, emerging markets, even frontier markets, move in an opposite direction. So when the Fed is expansive, those markets tend to do poorly. When the Fed is restrictive, those markets tend to do very well.
And then finally, can you give me some time horizons for investing with the Fed? Is it 1 year, 2 years, 5 years? What's the best way to approach it?
The best way to approach it is to monitor the direction of those interest rates. And sometimes those, the time periods tend to be very long. Expansive time periods can be quite long. Other times they're very short. So again, it's monitoring what the Fed does and not what the Fed says.
All right, thanks a lot, Bob.
Thank you, Greg.
Thank you for watching The Street.